What's up, everybody? Welcome to Send It, the official blockchain and cryptocurrency podcast from OKX Insights. I'm your host, Adam, and I'm joined, as almost always, by our head of content, Olivia. Olivia, how are you this morning?
I'm doing good. Drinking my coffee. Thank you.
Nice. I'm drinking a Red Bull, sugar-free. And our special guest today, who we're stoked to have on, is Jack from The Tie. Jack, how's it going?
Doing well. Thanks for having me on, guys. Excited to talk some Terra today.
Mm-hmm.
Yeah, we are too. Before we talk Terra, though, first, introduce yourself to the audience. Let them know about you, maybe how you got into crypto, and also a bit about The Tie.
Sure. Yeah, no, absolutely. So my crypto journey kind of unofficially began a lot of years ago, as many people do. Started mining Bitcoin on my computer. Fell out of touch with it a little bit and was working in traditional finance when I rediscovered DeFi about a year and a half ago, and quickly fell in love with it, got really in the weeds, and started publishing my own independent research, literally just on a Google Drive on Twitter. And then about 8 months ago, got in touch with The Tie, really fell in love with what we were trying to build, and then joined the team. And since then have been helping build out our research team internally, which is producing content geared towards institutional investors and token issuers, as well as doing bespoke data consulting for token issuers on our Token Lab side. I have found that a lot of the role is generally just trying to find a middle ground to help onboard smart institutional traders and investors into the space, help them understand what's going on, methods of valuation, and comparing to traditional finance counterparts, whatever it is. So at The Tie, we have a full service software platform, kind of like a Bloomberg, where you can get a ton of data at a really high level through, partnerships with large trading firms that we're getting data from, as well as a ton of in-house data. So really just trying to put together a cohesive data platform for people to actually able to centralize all of this information in the space that's literally all over from, we're scraping 7,000 different primary sources. So from Medium posts to regulatory information to social media, whatever it is, we have it all consolidated.
So because of that, you really got the scoop on what happened with Terra and Luna and UST and all that. In fact, you wrote an article, which we will link in the description, called Trial of the Lunatics, the story of Anchor, UST, and Luna. But before we get into the weeds, for somebody who's just tuning in, and they probably have heard about this big crypto collapse, and it was Luna or whatever, but they don't really know about what it is or even the basics. Yeah. Can you first describe what these things are, what Terra is, what UST is?
100%,
and also,
yeah.
Jack, also the volume we're talking about. So any dollar numbers to help give people context.
Yeah, so I think that's actually a really good place to start, just to frame the magnitude of what happened. Luna was at a $28 billion market cap, and UST was at an $18 billion market cap. And they're both trending to zero, if not basically at zero right now. So we're talking almost a $50 billion combined meltdown when you include some other selling data that we'll get to a little bit later. So this is really huge for the crypto ecosystem, which is only a few $1 trillion total in size, right? These are two top 10 tokens effectively. So this is not some isolated random incident in a small token. This was arguably the biggest meltdown we've seen in probably the past few years, at least. And because of that, there's a lot of implications on both the regulatory as well as the literal structural side, right? A lot of this was preventable. And that was a big point of contention with a lot of people, is that a lot of concerns had been addressed going in, right? So I'll kind of circle back to that a little bit later. But first, as you mentioned, probably worth setting the stage. So what is Terra? Terra was founded by a Korean founder named Do Kwon. He offshored the company to Singapore for obvious reasons. But basically what they were constructing was a blockchain called Luna, And the foundational component of this blockchain was going to be this algorithmic stablecoin UST, right? And in this case, an algorithmic stablecoin denotes a token that is not fully collateralized, i.e., USDC, USDT are fully backed by cash and cash equivalents. Allegedly, we'll see on USDT if they ever release. DAI is collateralized by fully on-chain tokens like ETH, and then an algorithmic stablecoin is generally partially backed in that there will be assets underlying it owned by the centralized company to help provide faith on the investor side, but some portion of it is collateralized by trust and confidence, right? So in the same way that a lot of the US government's issuance is collateralized by our trust in their issuance and their consistency over, based on the power of the US and all of its force, right? At the same time, what Terra was trying to create was an ecosystem where the mechanism of redemption and the power of the ecosystem is being used to replace some of the need for collateralization, right? And this is something that a lot of people have discussed, but for a number of reasons, algorithmic stablecoins have been a huge kind of, they're almost like the equivalent of the alchemist's quest to turn normal metal into gold, right? For crypto, right? It's like this perpetual motion machine. And Terra was by far the largest of these experiments to date, and there was a lot of confidence in it. And the primary use case for it was driven by this protocol called Anchor, which was an on-chain savings platform, basically, that was offering up to 20% yield on your deposited UST. So the Anchor stablecoin could be deposited in the platform for a subsidized rate of 20%, which is obviously alluring for a lot of reasons. What we kind of saw happen from a big macro perspective before we kind of dive in is during the past 2 years, a lot of concerns with this yield rate were not as top of mind, because as the market's growing, right, Anchor subsidizing $500 million every 6 months or every year to top off the reserves and make sure that the yield is sustained didn't feel like a big deal, given the fact that they had grown, $46 billion of combined market cap over a couple of years, right? So it felt like the risk reward was definitely skewed. But at the same time, there were a lot of mechanisms within UST and Terra that felt as though during a bear market or during an unwind, that they could be really problematic for the same way that they had incentivized growth during the bull market. So what we saw was, obviously there was a lot of macro pressure x the core crypto market, right? From inflation going up, from the Fed raising rates, from trade pressure and war abroad, all of that kind of shifts investors' mindsets to being more risk off with their assets, right? Like, I want to invest in stuff that's less risky, less yield, but has a lot more stability. And because of that, when you think from a stablecoin perspective, where am I putting my money, right? It's probably USDC, maybe USDT, because they're fully collateralized by something that I have a lot of faith in, versus something that is floating, algorithmic, and has some, we'll call them flywheel mechanisms, but Ponzi-nomics, right? Built in that could prove to be a big unwind, which is exactly what we saw. So that's kind of the broad setup, and then happy to dive in wherever you guys think would be most interesting.
Maybe before we dive in to what happened, sorry if I cough. Before we dive in specifically to what happened, do you think, there was clearly a lot of money in this thing, right? A lot of money apparently from the institutional side, crypto hedge funds, it seemed like predominantly. I don't know about how many traditional hedge funds really had money in there. But a lot of the big crypto entities had a lot of money in there, but also a lot of retail had money in there. Do you think that, even both sides, let's say, do you think that they had really done any kind of due diligence on this at all, algorithmic stablecoins at all, or the risks involved? Or do you think retail specifically, maybe they just viewed it as a savings account, and they were like, well, this is a relatively safe savings account where I can earn 20% yield, as opposed to keeping it in real dollars in my bank, my FDIC insured bank, where I get what is it, 0.025%. I don't even know. It's like,
I think, I got an offer yesterday for 0.5% because rates are going up, and they're like, congrats, we can offer you 0.5%. And I was like, please get off of my screen. I think that's a great question. Yeah. And I think that the answer is no, right? Like, no one was really doing due diligence on this, especially on the retail side. Even on the institutional side, right? Like, a lot of big token issuers, like, I'm not going to name names for the sake of your podcast, but even like a lot of your competitors were using anchor yield to kind of juice margins and like offer retail accounts on their platform, right? So this is kind of the extent to which it was proliferated. Like, there were major crypto funds offering, anchor specific ETFs towards people that didn't want to like onboard on chain. And, as a heavy crypto Twitter user, as I know like you are as well, Adam, I'm sure you saw a lot of posts about how the UST and Luna mechanism works in an up market, right? UST gets minted, Luna gets burned effectively, and that creates upward pressure on Luna as long as UST is growing. So that creates this incentive to get as much UST into circulation as possible to boost prices, right? And so the way that they were doing that was through aggressive subsidies, but rather than having them put into a system where the tokens are actually getting used across crypto, like actually being used to transact, being used in liquidity pairs, all of these various means which we have seen for stablecoins, instead, their sole purpose was being used in this bank account, right? So 70% of UST in circulation was in Anchor. And when you kind of think about it, Anchor is entirely subsidized, right? So people are in Anchor for the 20% yield, not necessarily for anything specific to Luna. And so conversely, if yield dropped, if it stopped getting subsidized, if something happened to UST, there isn't really anything sticky actually keeping people in the system, right? Mm-hmm. So the counterfactual is then, okay, if UST is not getting minted, but is instead getting burned or sold or off, what is that going to do to Luna price pressure? And we saw exactly what it does. If that portion of Luna that is backed by confidence, if that confidence evaporates for whatever reason, then what we will see instead is a death spiral. And that's exactly what happened.
So, yeah, now I guess we can get into the weeds then. So how did this death spiral occur? Like, because again, you wrote the article, which we're linking in the description, which I think does a good job of laying it out. But can you also lay it out here? Like what happened? What set the whole thing off? What put the death spiral in motion?
Yeah. So there's two main points to kind of touch on before we actually go into the mechanics. The first is this flight to risk off assets, which I already touched on via macro conditions worsening. So people going to less risky assets, less yield assets. And the second thing, right, is this underlying asset liability mismatch for UST, right? Like I said, a portion of it is collateralized by confidence. So you can consider that like the size of the mismatch, right? In that UST is debt that is effectively owed by TFL to purchasers or traders of UST. And they have a certain amount of capital on hand, which is partially backed by, or largely Luna. And then on the other hand, like a small amount of BTC, which like we'll probably touch on later, right?
Can I just clarify there? So the that's Terra Foundation.
Oh, sorry. Right? Yeah, Terraform Labs, right?
So so this is all one ecosystem. I also just wanted to because it's I think even for people in the industry and familiar with these companies, sometimes it's not super transparent. But like Anchor, 100%. The protocol, the bank that we're talking about, it's not a bank, but like the savings account is like also owned by Terra.
So
or how is that relationship? Maybe I don't even know.
Yeah. So like technically, there are three separate. Thank you for bringing this up. This is an important point. Technically, there are three separate entities, as I understand. The first is Terraform Labs. They're the kind of the core issuers of Luna. The second is Anchor, which is an independent savings platform. but that had become such a core part of the thesis for UST and Luna that it was getting aggressively subsidized by Terraform Labs to the point where, in my eyes, there's functionally no difference. And the third entity is Terra Swap, which is the way that this spiral kind of unwound. And the reason for this is because at any point in time, regardless of what the secondary market price is of UST, if UST is trading up 50 cents, it doesn't matter. I can always go to Terra Swap and exchange $1 of UST for $1 of Luna, up to certain volume quantities a day, which like became relevant but are functionally irrelevant the majority of the time. So you have this three-pronged system where technically they're independent. And this was like a big point of discussion I had with Terra Labs people going literally months prior to this event, was like there would always be this discussion of like, hey, these are separate entities. Technically, UST isn't collateralized. It's algorithmic, da-da-da-da-da, right? But functionally, the way that the mechanisms actually worked effectively had everything centralized. And we even saw this during the meltdown, right, where Terraform Labs, or they even called themselves, I think, like the I forget. There was another core group of Terraform Labs people that were making
the Luna Foundation Guard.
Luna Foundation Guard, yeah, exactly. The LFG. The LFG group was making executive decisions on behalf of like how to stop this death spiral with no votes from anyone, right? Like not super decentralized. So yeah, that's a great question, Olivia, and it's a big part of why this actually was able to go down.
So like, yeah, the confidence chunk, to come back to, as you're explaining the beginning or how the death spiral happened. So the confidence part, collateralization, is like in this entity, Terraform Labs.
Yeah, exactly, right. And what ended up happening in the most basic level is as confidence in UST went down, people were trying to market sell their UST. That caused the price of UST to go down. Arbitragers then see that the price of UST is going down, right? So they can buy UST on the secondary market at a discount, go to Terra Swap, redeem it for $1 of Luna, and then immediately market sell that Luna to realize their arbitrage profit, which in turn prices down Luna. That means that the next time someone comes in to make that exchange, they get even more Luna than the person did previously for their dollars of UST. And that even further pushes down the price of Luna. And there's even this other weird thing that's happening where like the further the price of UST gets from its dollar peg, the more that they are effectively paying out in terms of like actual assets that they're taking on from doing this versus liabilities that they're paying out, right? Like they're minting and then issuing and then taking on assets that are literally worth less on the market than what they are minting and selling, under the assumption that at some point it will return to peg, right? So that's kind of the algorithmic mechanism for returning to peg, which obviously would work well in a bull market where there is a lot of confidence in return to peg. But if the loss of confidence is the actual underlying issue, then making this trade is almost like begging the question of UST stability, and like really allows for things to get out of control very fast.
Right. Like, so, okay. So that was a lot. That's a lot. The mechanism.
This is only getting more complicated too. So I apologize in advance.
No, it's not. No need to apologize. Just want to make sure everything is like clear. Cause like it is a complicated situation. And for people who are interested in understanding, hopefully they'll be able to understand and follow us. So when you said people are market selling UST, they're like, okay, getting rid of their UST. And then I just didn't, for anything, or?
Okay, yeah. So here's basically like the way that the flow diagram works, right? Is you have Go ahead. I'll do like a drawing on my screen, right? So there's UST is not just being traded on Terra, the blockchain, right? It has a ton of liquidity on centralized exchanges, on decentralized exchanges, on other chains, wherever it is. And because of that, the pricing can really vary, right? So from an arbitrager's perspective, if there's this lack of confidence, people on FTX are going to be, just like as a random example, are going to be selling their UST on the exchange, which would cause the mispricing. And there's no way for that mispricing to get corrected on the FTX exchange. So what we need instead is some arbitrager to come in, buy the UST off the FTX exchange, like withdraw it, bridge it to Terra, put it into Terra swap, and then redeem it for Luna, which they then sell, right? And so that's kind of the flow, is all of these liquidity pools elsewhere are getting drained of their UST, and then that UST is being market sold back to Terra, basically in exchange for Luna, which is then also immediately being sold, right? So what ends up happening is Terra is accumulating a ton of UST, and they are exchanging it for Luna, which is increasing the supply of Luna and driving down the price per token as well, which is why we also saw this astronomical growth in Luna supply up to literally the total floating supply of Luna increased like billions over the past week or so.
Yeah.
It's pretty crazy.
And because you always can redeem $1 worth of what?
You can always redeem $1 of UST for $1 of
one UST, right? It's supposed to always be $1. So you can always redeem your one UST, which is supposed to be equal to $1 all the time, for $1 equivalent of Luna.
Exactly.
The amount of Luna that as the price of Luna goes down, you need more Luna to make $1.
Yep. And now you can kind of see the issue, right? Where like the supply of Luna is being increased at an accelerating rate, which in turn is driving down the price at an accelerating rate.
So you need more and more and more Luna to fill it all.
Yep.
Yeah, I got it.
And for the arbitrager, like in its most simplest terms, maybe right, they're just getting free money from Terra, right? From these entities. So let's say the price of UST at any specific moment is 50 cents. So they're giving, it shouldn't be, but they're giving 50 cents to Terra in exchange for $1.
$1, yeah. And then
it just gets worse and worse.
Yeah, okay. Yeah. But they have
this
to
is traditionally known as bad business, by the way.
Get out of
You usually
Luna.
don't want to be selling your dollars for 50 cents.
Yeah.
They're like colloquially what's known in this space as exit liquidity. Like traditionally, you don't want to be someone's exit liquidity, and that's exactly what just happened.
And so what happens with that point? So like say like I'm able to get some UST at a discount because it lost its peg and now it's 50 cents. And so I get UST and I'm going to go redeem it for $1 per every 50 cents in Luna. Yay for me. And then how do I get out? And then what happens with the Luna? You have to get out immediately. Because the price is still falling, right?
Yeah, so basically, like you would hope that in the period from where you received your Luna to when you actually sell it, the price of Luna hasn't fallen more than the arbitrage profit that you've made. Realistically, the majority of people executing this trade aren't people like you and me, like clicking the buttons as fast as they can. It's someone running code and trying to execute it as close to simultaneously as possible. But it was like a real issue, like there were points where like I remember I was watching a lot of this in real time as it kind of unfolded over a few days. And like there were points where stuff was getting arbitraged for like hundreds of millions of dollars an hour effectively, right? Like it was huge volumes.
Wow. And where is what dates is this like starting? Is May 8th it's before that or
May 8th? It kind of I'm a little unclear on my days, honestly, at this point.
Well, I know like the whole.
Let me pull up my calendar because all right. So I started watching it on probably Friday or Saturday, the 6th or the 7th, because at that point the primary non-Terra liquidity pool was this bridge pool, basically that was located on Curve. And in the Curve pool, Curve is like a primary market maker AMM for stablecoins. And in the Curve pool, UST was being pooled against what they call their 3CRV token, which is a combination of UST, USDC, and DAI. And so basically people were using that pool to swap large portions of UST for these other stablecoins, right? And that was already showing me, as someone who's watching kind of casually at this point, that there's a big flight to risk off stablecoins occurring. And if you read the article, like I even link the Etherscan links where you can actually see big trading firms that support Terra actually coming in and refilling the pool to the tune of $250 million, because they already saw that this was quickly unwinding and wanted to support it before they realized the magnitude of what was going on. And I even tweeted on like Saturday or something like that saying, hey, like if you are expecting institutions to ride in and save the day on this UST depeg, be really cautious, because like this could unwind much more quickly and end up a lot more expensive for them than kind of the general consensus is. And if that is the case, then they're just gonna go hands off.
And there's even another play going on as this is happening as well, from like even just from maybe like the retail speculator side. I know a lot of sort of just individuals on crypto Twitter were taking this trade specifically where they were just simply shorting. When they saw that things didn't look good, they would just short Luna or short UST on centralized exchanges or whatever, which adds, it creates a potential for a short squeeze, but it also ultimately adds significant more downward pressure.
Yep, 100%. And I personally know, I'm not going to like dox my own trades or anything, but like I personally know a number of people who were short Luna on the way down, and there were obviously like a number of extremely part of the reason for this meltdown too, and this is the smallest part, was like the founder Do Kwon was making huge size bets with a number of significant traders on crypto Twitter who, these are educated investors willing to put $20 million on Luna downside because they like see what is happening, right? And so a lot of smart institutional money had the downside on this trade.
Yeah, and one of the individuals, GCR on Twitter, he what was the size of the bet? Was it 20 million?
It was a $20 million short position that he opened, and by the time he closed it out on that $20 million borrow, he paid 72 cents.
Yeah.
So that gives you a sense of exactly how much value was lost in Luna.
Wow.
It's like, that's, people have likened that to like one of the best trades, if not the best like trade ever, like in like crypto Twitter or whatever. It's
definitely up there. It's definitely
outstanding.
Up there.
Yeah. Not the narrative you're hearing a lot of right now, but some people were being smart.
So now that we know what happened and sort of how it happened, well, before we get into maybe the fallout, there's been a lot of speculation from the Terra camp, as well as other people, the not Terra camp, that this was one big entity, right? That had some interest in executing this. The comments, like conspiracy theory that went around, was that it was Citadel.
Dude, I've gotten asked this so many times. I think it's the biggest BS rumor of all time. Like, I don't know. Like, all right, I could be wrong. Like, I've been known to be wrong from like on stuff like this. I think the odds of it being Citadel are extremely low. If you like look at the notional size that was needed for this, right? Like they would have needed to have a ton of crypto assets. They're not like trying to execute something like this that could get them into regulatory trouble, IMO, and all of that belies the actual point that matters for me, which is that if it only takes $1 billion trade to bring down this entire ecosystem, then there is something fundamentally wrong, right? And the fact that it was attacked is almost a distracting fact from the core issues that were actually going on here, which, like, honestly, this attack could also be looked at as a blessing in disguise, right? There was going to be a ton of UST liquidity launched in the next 3 months with some partnerships with Curve and other programs, right? So, like, if you're thinking about contagion to the broad DeFi ecosystem, it could have been an order of magnitude or more larger a few months down the line, right? So I'm not saying that this was a good thing that it happened. It, of course, is like terrible. We don't like when we're losing 50% of the net worth of our ecosystem in a few days, and a ton of retail traders who were kind of misled as to what was going on are getting wrecked. Like, that is never my ideal outcome. I think it really hurts the credibility of the space. But I think at the same time, we may look back on this to a degree and be thankful that it wasn't allowed to go further before it actually collapsed.
Yeah.
Yeah. For me, I think one of the big red flags, and I think one of the main problems with this, besides like technically and fundamentally how it worked, which is an issue, I also think there's a wider issue that's been pervasive in the industry for years, is like the idea of the figurehead, that people put their faith into the person more than the protocol. And in this case, it's Do Kwon. And I mean, I've been pretty vocal. I don't know the guy personally. I've been pretty vocal that I find his presence on Twitter before all of this like extremely abrasive, like rude, not great, and very
the cult of personality. I've been calling it.
Exactly what I was going to say. Yeah.
And there's other individuals in this space who are similar, but again, and nobody likes to see this happen. So I'm not going to sit here and say it was a good thing, but a certain part of me certainly feels like this individual kind of had it coming, because he was almost bringing it on himself with his bold claims, his saying like this stuff was impossible. Is the death spiral in the room with us now? Like all of this stuff up until the moment it happens, and then
just like trolling his way into the death spiral. That's
I mean, you even see like Daniel Sesta in Wonderland, right? And Seafood Meltdown, another similar cult of personality situation where like I think this is a key point for me, like from a philosophical level in the space, right? Like, this is supposed to be a meritocracy, and yet people like commonly find themselves swayed by these larger than life personalities who are promising something that feels functionally impossible, yet people ignore that gut instinct in favor of like chasing something that isn't real. And like, that's never going to be possible. And the less that we can give these sort of builders a big platform, like the better, I think, and the healthier the space will evolve.
Yeah, I just wanted to like dig into that narrative a little bit. Like, there was the sort of narrative of like saving the market or buying a lot, like Do Kwon buying a lot of Bitcoin, and that people could have sort of like seen as a positive thing for overall, for, it's kind of like Michael Saylor, like, yay, just like buy more. Could you maybe talk about the relationship, that how that relates to UST basically, and maybe any more background on that?
Yeah, so the purchase of Bitcoin was important because in a large part, it was going to be used to diversify the kind of underlying collateralization sources for UST, right? Like, it's not technically collateralized, but it's functionally collateralized is what we'll call it. And so in the previous version, Luna was effectively the only thing backing UST, right? So there's, again, this element of circularity where, in an up market, it's fine because like Luna is going to clearly outpace UST because one's $1 and the other is like a liquid asset that's going to be, gaining market value. But in a down market, like Luna could be dropping a lot faster, right? So having more assets in the bank to kind of support these liabilities that Terraform Labs has was really important to the thesis, and also making sure that the circularity was like slightly less was also really important for them.
Like, you have a decentralized, like you have basically when you say in the bank, it's like it's Terraform Labs, the issuer of UST, holding Bitcoin.
Yes.
Yeah. Okay. Yeah, because like, I mean, when you say liability also, I mean, these are really, this is like, all of these topics are kind of just deeply about how money works. And like, in this case, it's like the reason that there's this like gap, like you said, with confidence being not the collateralized part, but just like the emotional part.
The algorithmic part, The
algorithmic part. I mean, that's like, because the way to say that in simple terms, right, is like, if you have one UST, it's just like $1. It's an IOU. Like, it is, you're owed the value of $1. You like should be able to redeem it for $1, and you literally could, in the sort of with the Luna Terra swap thing. But like that makes sense. So he was kind of stockpiling more, just like a more separate asset from this like cluster buff.
Yeah.
And then
Yeah.
like and then like that was just separately being seen as a bullish thing, obviously, anytime someone's buying a lot of Bitcoin.
And I think, to interject real quick too, I think like one way maybe describing it and why they're adding Bitcoin that I saw a lot of detractors talk about was that basically what you had was like shit wrapped in shit, but by adding Bitcoin to it, you were making it
gold-plated shit.
Yeah.
No, yeah, I think that's almost exactly right. And it was the biggest issue is just like the magnitude of the purchase was kind of like too little, too late, and they burned through those reserves trying to defend the peg, and it was clearly not even close to sufficient to stopping the burn, right?
So okay, I don't know if we need to get into what that means.
Yeah,
but just like okay, whatever. I they had to have those extra reserves, and then they burned through them really quickly. And of course, then the price of Bitcoin and everything is like dropping at the same time around this. So that's also
I mean, you can basically just think about it as like they took that Bitcoin, went to trading firms, said, "Hey, I'm going to pay you in Bitcoin. Use this money to buy UST if it's dropping below $1, right?" And again, this just resulted in Terraform Labs spending all of their billions in Bitcoin defending the peg, i.e. becoming exit liquidity for all of the people that wanted to exit in size off of these exchanges.
Yeah. And bringing it back quickly to the setup, right? To the risk off macro environment. There was a major red flag even from the very beginning when they announced that they had plans to purchase $10 billion of Bitcoin over like a relatively brief period of time. And the fact that someone would announce this and not get immediately front run and not see a significant increase. We did see a slow and steady sort of grinding up in the price of Bitcoin, which was largely them and Saylor, I think, a bit TWAPing in, which is essentially, for those listening at home, buying in certain time intervals. And it sort of ground the price up a bit, but there was very clearly no demand to front run a $10 billion Bitcoin purchase. Which was a very big red flag and an indicator of, like you said, a massively risk-off environment of anyone with the means and to buy substantial amounts, institutional investors to buy substantial amounts of Bitcoin were not interested, even knowing that somebody else was going to buy 10 billion. So not a great setup. Yeah.
And in fact, it kind of suggests like the counterfactual, right? That like people were, again, using DOE as exit liquidity in this case, right? Like using this opportunity of these massive Bitcoin market buys to sell their Bitcoin or these OTC buys.
Mm-hmm.
There was even conspiracy theories, though. This could be totally wrong, but it's things that I heard that that DOE was providing exit liquidity intentionally for certain entities or certain individuals because you commonly don't announce a $10 billion Bitcoin purchase. If you really want to execute it at the most optimal price, you don't let somebody know you're doing it.
So like if this was, so I would have agreed with you before. I honestly, after seeing the way stuff was handled after the fact, like I just think this dude had no idea what he was doing. Functionally, I think that like he had some interesting ideas, and like there's also this weird tidbit that came out where he had been running a second stablecoin project on Ethereum under a pseudonym simultaneously with like the early launch of Terra that collapsed, right? So he was clearly kind of trying to spread his eggs in a basket, like didn't necessarily have like a lot of conviction in like one model as being inherently superior necessarily, or I think that like he kind of just got in over his head, honestly, and saw in his eyes like the primary thing that mattered was increasing issuance of UST at all costs, right? We saw problematic use of UST in the Abracadabra degen box, which was basically this mechanism that allowed people to take UST and leverage it significantly in Anchor so that they were earning over 100% APR. And right? And like in terms of what that means for Anchor, it means that like someone is able to basically like juice their yield 5 to 6x what was intended. So they're paying out a significantly larger portion of like debt on their end to these people that they owe yield versus the amount of money that they're actually taking in, right? Because like these people aren't actually depositing collateral. And so there's just like a lot of weird decisions that were made to almost artificially grow UST supply through subsidy in the hopes that it would pay dividends, but not realizing that the means by which supply was growing wasn't sticky at all. And that was like really the key underlying issue was like the lack of stickiness of like where UST was being held.
Yeah. I have a zoom out proposal. Well, it's not that zoom out, but I want to read this quote, and then maybe that will bring us into the like after effects discussion. So I have this like report from the co-founder of Reserve, which is like a protocol that has another collateralized stablecoin. And this person, we wrote an in-depth about the Luna. We at OKX Insights, Rick wrote an in-depth about the Terra Luna stuff the other day and like quoted from this report. It's like an unpublished report. It's circulating, the Google Doc thing that we do sometimes. And I want to read from that report from the Reserve co-founder, just like I think we also quoted in our article, because it's like it's a bold statement. So this is a statement. It is essential that we do not allow algorithmic stablecoins. We do not allow algorithmic stablecoins to be used as a savings and spending tool by the broad population. It's not practically feasible for every individual to become an expert on monetary dynamics before they decide which financial products to rely on. As an industry, we absolutely must call out any further attempt at popularization of algorithmic stablecoins among non-sophisticated users, and our exchanges and wallets must not support their mainstream use. I am really curious if you have thoughts on that.
That's an interesting take. On the one hand, I kind of agree because there's a lot of risks that are still to be determined for algo stablecoins that make them really inappropriate for people that don't understand the risks of what they're actually buying, right? At the same time, I kind of struggle to reconcile that with my belief that a lot of these products should be available to the vast majority of investors to allow people to make their own decisions. Like I kind of am not a fan of this, like, oh, we're only offering certain securities to like registered accredited investors, whatever it is. And there is also this other element of, I think that algorithmic stablecoins is an area where there can be interesting work done. For example, Frax is someone who's doing some interesting mechanics on algo stablecoins where, the yield that they are offering on Frax is significantly lower than UST, but they also have some models that they have created, for example, which like automatically arbitrage some pools they have, and that is how yield is being generated, right? So rather than subsidizing yield, a lot of it is being generated organically, and then they adjust the collateralization ratio of their stablecoin algorithmically. Like that's where the algorithm comes in based on a floating level, right? Versus like having it fixed and assuming it immutable. So in broad strokes, I would say that like I don't disagree with that statement, but like on the nuance, I hate to like rule off some of the assets that could potentially make crypto really interesting over a longer term time horizon because we deem them too unsafe right now. There is like this element of being able to create novel products via on-chain mechanisms that could create like some really interesting synergies. But that said, for right now, I'm kind of like in that camp, especially after this meltdown.
Yeah, it's definitely like a larger debate. It's not that those shouldn't exist. It's that like, who do they exist for? Who's interacting with them? How do we like as an industry or community, if we consider ourselves that, kind of like help avoid the situation that we just saw, where like it's not just these big hedge funds, but like individuals are really suffering in this
100%.
case. Yeah.
And that's a big deal for me. And then you also end up with this other side, though, right? Where as I'm thinking about it, there's like this reality, rather, where, you know, if the majority of these assets are going to be supporting, you know, liquidity pools and DAO treasuries and stuff like that, right? How does that change the underlying risk for the retail investor as well, right? So if like a lot of assets in treasuries are tied up in these risk on stablecoins, and then they were to also melt down, and retail just holds tokens in the underlying protocols, like to what degree are they still exposed, right? And the answer to that is really hard, and it kind of gets at this broader question of how do I measure systemic risk in crypto? And it's something I've been thinking a lot about, and like haven't really been able to come up with a good solution for, because, you know, everything's so correlated, everything's so intertwined and built on top of each other, that it becomes hard to kind of figure out exactly how to bucket your risk and hedge against it.
I would pose the idea as well that we don't need an algorithmic stablecoin that's pegged to fiat, because for multiple reasons. So first off, if you're like a crypto maxi or have those tendencies or whatever, then philosophically, you should be aiming to divorce yourself from fiat, from the dollar in the first place. I mean, that's one of the core kind of ethos for like the more philosophical crypto maxi type person. If you want exposure to the dollar, for example, or fiat, then you have collateralized stablecoins that provide that to you. So if your goal is to peg yourself to $1 so you can execute trades in hopes to buy more Bitcoin at a lower price or whatever, those are available to you. And I question the need to have a decentralized stablecoin pegged to fiat, which is inherently obviously centralized. So it seems fundamentally wrong from the start, in a way that like, yeah, I think you get what I'm trying to say, right?
Yeah, no, it's almost like an oxymoron, right? It's like a jumbo shrimp, right? Like, I think that's a great point. And like, I don't know if you were like an Olympus maxi back in the day, but I was originally when they first started launching their project, before it started to get a little bit confused, which was like creating this reserve currency for DeFi that isn't actually pegged to $1. It's a floating currency based on an underlying basket of treasury assets that are all DeFi native, right? Like, that's the vision for like the currency that I would love to see in crypto. But at the same time, like balancing that with someone who's less familiar, less of like a blockchain maxi, and like wants to use something that they're comfortable with. I think that, like you said, those fully collateralized stablecoins are a great option. And like, I'm 100% on board with you that I'm not sure that there is really in for like an algorithmic stablecoin pegged to $1.
Yeah. And one of the quotes, one of the mantras of the lunatics, as they call themselves, is that they would say, you know, the world needs, or crypto needs, decentralized money. But again, they're talking about a decentralized stablecoin pegged to the exact thing that you were supposed to be getting rid of, the most centralized money there is, which is central bank printed paper. Yep. And you're saying we need to decentralize that. Like,
and then also, mind you, that it's not even being used as money. Like, it's literally just being used to fuel their yield Ponzi and Anchor, right? Like, friendly reminder that 70% of UST was in Anchor, right? Like, this is my biggest issue, and this is why I keep returning to the point, right? Like, if this is actually being used as money is a method of facilitating transaction, and that is not happening with UST. It is parked in the bank.
Yeah. We have a decentralized money in that case, which is Bitcoin. But
yeah. If you want something that's a store of value, just buy Bitcoin, right? Like, park that in the bank.
But yeah.
Not financial advice.
Not financial advice. Please buy my Bitcoin.
Speaking of, like, on the topic of wider fallout, I guess. Well, one, now as of today, I believe it was announced earlier today, there's a proposal to make, Terra, UST, so Luna, UST, all this stuff, Terra Classic, right?
Yep.
And essentially start a 2.0 version of the whole thing again. What's your take on that?
Yeah, I have no interest in it. I don't think people are going to have interest in it. I think that people have interest in it long enough to try and recoup their profits, and then they're going to dip. It's problematic because the underlying functionality and issues that I have had with it from a mechanism perspective and also from like this actual use case perspective remain unchanged, right? So how do we actually address for that? And they're talking about moving to like fully collateralized. And then at that point, like I don't really understand what the actual use case is for it. There are a lot of fantastic builders on the Terra ecosystem, so I don't want to let that go unsaid. But at the same time, right, especially when you have this system where a large part of what's going on is predicated on confidence and good faith acting, I don't really see a scenario where that's going to recover. And I think that even if the relaunch, like there will always be like diehard lunatics, I think, who are going to be like the Ethereum Classic maxis of this. But I don't know that this really ever sees significant uptake.
Mm-hmm.
Do you think now that this spurs on a bear market? Not to just throw like a hot question at you or whatever. Obviously, we saw the immediate fallout of this. We saw a lack of confidence, which I think was probably unwarranted, in Tether, right? So a lot of people raced to exit Tether, which caused
just because it's a stablecoin.
Yeah.
Well, it's a little more complicated.
Yeah. Okay, but
it's technically because they're backed by cash and cash equivalents, and a big question of the crypto community has been wanting to see exactly what the balance sheet of Tether is versus their liabilities, and they refuse to disclose that. Because it's their secret sauce, their words, not mine. Right.
Many years.
Exactly.
Yeah, they have a long history, don't they?
Yeah. Well, I'm more saying like for some people, there might have been like a immediate sort of associated panic of any USD pegged stablecoin, not really understanding the different kinds of stablecoins that there are, like fully collateralized, kind of over collateralized, algorithmic. But anyways, and then with Tether, it's its own saga that's, as we've been saying, been going on for many years, where we're like not able to get the audit to see exactly what's backing, but it's like massive. It's the third largest cryptocurrency by market cap. It's used across the entire industry. It's like the backbone, for all trading, etc. So like, I guess I was just saying like, there's this like associative panic, but my understanding, and this leads to the larger sort of effects, tying into Adam's question, is that there's worry about like regulatory backlash against stablecoins at large, right?
Oh yeah, I mean that's 100% coming. There's this situation, right? I think that like you hit the nail on the head just now, right? There's two main factors at play here. The first is educated investors risking off of what they see as risk on stablecoins into risk off stablecoins, which is primarily just USDC at this point. And then a second group kind of exiting stablecoins for either fiat or like Bitcoin or Ethereum or something like that entirely, right? And I've heard a lot of interesting discussion from institutions where they are hearing in Washington that, discussions on stablecoins up until this point had only been focused on fiat-backed stablecoins, right? Like they weren't even really aware that algorithmic stablecoins were something that they needed to be in touch with. And after seeing this meltdown, it definitely has caused them to reframe the discussion. And it seems like they're hoping to get legislation out by the end of the year for stablecoins and helping kind of set the grounds for either a central bank digital currency, a CBDC, or at least kind of shoring up what has been a little bit of a lawless space, especially in DeFi.
Yeah, Janet Yellen was very quick. Sorry, I was going to say Janet Yellen was very quick to bring up the UST collapse almost immediately. It was amazing. Which added a bit of fuel to the conspiracy theory. behind the Citadel thing, which again,
some aide was definitely just like trading crypto in their free time, had a portfolio down 70% overnight, and was like, "Oh my god, all right, Jenna, let's get this guy."
Yeah, and they were like, yes, exactly the silver bullet we need or something.
Yeah, exactly.
I was just gonna clarify. So the reason that USDC, just to explain like why people would think USDC is safer as a fully collateralized USD pegged stablecoin is because they have shown the assets that back this stablecoin, right? So they're
there's just a lot more. Yeah, there's just a lot more clarity in terms of exactly what like the asset liability situation is on the balance sheet, and there's a lot more confidence in the ability to redeem one USDC for $1 at any time, right? Like that is always a big point, is like the ability to go one-to-one directly. Like this on-ramp from fiat into DeFi, like being able to execute that is super important for like stablecoin stability.
Yeah. Exactly.
And it's only really possible if you have like a balance sheet that matches your liabilities.
And that's like the right. And that's kind of the point, again, if we zoom out for a wider audience, of these stable coins that are like tied to the price of a fiat currency. It's not only USD, but that's the most popular ones. Right. The point is you can be still within crypto. You don't have to exchange your crypto for fiat and go through the banking system, but you can have a stability. So if you want if you want to make a trade into the stable currency like USDT or USDC, then you have dollars basically, because they should be and are always equivalent to the dollar value, but you're not getting out of crypto. And I think that's like the background. Like,
and you can earn yield, right?
And then the earn yield part is what got us into this situation. It's like, oh, there's this extra thing you can do. And that's what I think is so tantalizing or whatever tempting about something like UST and all the other stablecoins also you can earn yield, but like the UST promise and the anchor promise were all about not just like being the stable part. It's really about like the yield part. So
exactly right. And like I think that it's an important differentiation and point to mention, honestly, is we in the crypto space have gotten really desensitized to high yields. And so when we see like 2 to 3% yield offered on USDC, we kind of like shrug and like go, all right, who cares? Whatever. But for like we were discussing at the start, I don't remember if it was even before the start of the stream, right? Like rates in savings accounts are abysmal. Like I have gotten excited flyers offering me like 50 to 100 bips on savings accounts, right? Like 0.5% to 1%, which doesn't necessarily feel like a huge difference on paper, but especially when you're thinking about stuff like company balance sheets, right? Like if they have hundreds of millions of dollars sitting idle effectively that they need to earn yield on, the difference in your margins between earning 0.5% versus 3% is huge. So like having the ability to supplement your yield, supplement your margins like that is really important, especially if a lot of that yield is being sustainably generated and you have insight into how it's being generated.
So
well,
overall,
well, I was gonna say, and on the collateralized stablecoin front, looking at USDT and also in USDC, which I should mention real quick too. OKX is adding a bunch of USDC pairs for anybody listening at home interested in trading against USDC instead of USDT. But anyways, we've seen a decline in the supply of USDT and USDC as people with access to redemption mechanisms are redeeming them for actual dollars. And historically, this is usually indicative of a bear market. Generally speaking, when the Tether printer is going burr, that indicates that
technically speaking,
somebody
wants to buy more, right? And it's easier to have stable coins in order to do that or earn yield or whatever. And
or it means that the Jerome Powell money printer is going burr, so people are just swapping into stables.
But when the incinerator turns on, the Tether incinerator, and starts burning, that's usually not indicative of upside for the price of Bitcoin or the wider market in the immediate future. So back to the hot take question. So are we in a bear market? Are we going into a bear market? How long was this going to last?
Yeah. I am mentally planning not to even get close to all-time highs this year. Like I'm fully ready for that. Like when you look at all right, so my short answer is like I think that it's going to be a tough market. I am an investor, not a trader. Important distinction, right? So like I'm looking out with a longer time horizon, and like I am still secularly bullish on the uptake of the crypto space broadly. Full disclosure. The second point, right, is like the reason that equities have been mapped so closely to crypto lately, right, is because of these macro issues around war, around federal monetary policy tightening, around
inflation.
Around inflation, exactly, right? Where these are issues that are giving people less available cash in their pocket to spend on whatever it is, gambling, gambling on chain, like whatever it is that you want to do. And so because of that, like I think that as long as the macro trends continue to be unfavorable for broad spending globally, I think that it's going to be really hard for crypto to push through to new all-time highs. At the same time, there's this other secular leg at the trade that you kind of have to look at, which is that despite the fact that monetary policy is tightening, there should still also continue to be institutional uptake in crypto as regulatory gets cleaned up, and also just uptake on the business side as people realize they can kind of help their yields, and like as more off-chain products get brought on-chain in kind of creative ways for businesses to get involved, right? That will help move capital into the broad crypto sphere. So that should help offset some of the negative effects. But again, that's like a 6 to 12 to 24 month time horizon, not like 1 to 2 months we're getting in and out of the dip and moving on. Sorry for the bad news, guys.
Insightful. That's all good.
I agree completely, by the way. Though I also do think, again, none of this is financial advice, of course, or whatever. Yeah. But I also do think that, at the bottom, whenever that may be, I'm not going to call it, but I do think that we're probably closer to the bottom than we are to the top, and also that maybe prime generational buying opportunities are in sight. Again, that's not financial advice. That's just my opinion.
Not financial advice. Like I personally, right? Like if you are someone who believes in the long-term vision of crypto, like if you were excited about buying Bitcoin at $69,000 a few months ago because you really believed in the space, like now is actually the time to start VWAPing, like Adam mentioned earlier, into your portfolio, right? Like I have a small set portion of my paycheck going automatically into Bitcoin every month. So that way I can just purchase a small amount, set it and forget it. And then, hopefully in a couple of years, come back to like significant ROI, right? And that's kind of how I'm thinking about framing it right now. And then on the other hand, like this is also the time in this cycle where if you find really interesting projects on a protocol level basis and begin to like really tactically position yourselves with what are honestly very small amounts of capital, you can get crazy, 10, 20x rewards on the next bull market cycle if you find a project that actually has interesting tech.
Yeah. And side note, another OKX plug I want to make is that we now have a recurring buy function with our trading bot. So you can set it and forget it, as you said, Jack.
I love it.
And that is in our app and web. So yeah, that makes things easier for people. The old DCA.
I love DCA. I love it.
100%.
Yeah, very time. We have an article about why it makes sense to investment strategy. But without giving any advice, I felt like I had a last question or a follow-up, but I just forgot it after my plug. The last thing you said was about yield.
Protocol level idiosyncratic upside in the next bull market if you find projects that are doing cool tech and like scale into them at very low risk allocation.
Nope, it didn't trigger anything in my brain. It didn't work. Whatever. It doesn't matter. Do you have anything?
I'm available whenever. Hit me up on Twitter if you.
When I remember.
I will say, when you said if you loved Bitcoin at 69K, you're really gonna love it. I do I remember distinctly, just a personal anecdote, writing to one of my friends, near the top of the board, and just being we were at peak euphoria, and telling my friend they're not gonna let us buy cheap Bitcoin ever again, are they? They being institutions. This was when all the news coming out every day was another institutional buy, and it's just this thing's just gonna keep taking off, and they're never gonna let us get it cheap again. And now, here we are.
Yeah, maybe they won't let us get 3,000 again, but 30.
Yeah. But I at that time I sincerely didn't believe that we would ever retest the previous all-time high around 20K, which is now in sight. I'm not saying that's going to happen, but it's a realistic possibility at this point. And back in peak euphoria of the cycle, I truly didn't believe they were ever going to let us get that opportunity again. So if you have that in mind,
that's when it's time to sell. I know whenever I'm wow, this token's never going down, that I need to start DCAing out of it.
It's hard with Bitcoin though. That's my problem. I can part ways with almost anything other than Bitcoin and Ethereum relatively easily when I start to feel euphoria. But it's there's always that part of me that's just Bitcoin is the base of my life. I work in crypto, and it's Bitcoin is my standard, not the dollar. So, and then you just watch the dollar, your net worth in dollars decrease, and you're and
you're losing 8% to inflation. So it's just double bad.
Yeah. But you're one Bitcoin is one Bitcoin, so it's fine.
Yeah, one Bitcoin is one Bitcoin. Exactly.
Yeah.
Yeah, on that note, I know you have a panel you got to moderate, so we will let
Busy
you go.
day for talking to smart people, so I appreciate.
What is the panel, by the way? What is the panel?
What's the conference?
I'll be at the ARCA Digital Assets Conference, which is primarily targeted towards institutional investors, and I'll be moderating a panel on thematic investing in digital assets. So getting to talk to Alex, the head of research at Galaxy. I'm talking to the head of research at Galaxy and the head of research at Masari, as well as the head of research at ARCA, and we're going to be doing a panel kind of thinking about how people are positioned, what are the best relative value and thematic trades that you can kind of be thinking about. And then, one of the things I'm really really in love with is the idea of us building this car of crypto kind of as we're driving it, and how you kind of can think through some of the implications of that, where yield is coming from, how we migrate Web 2 onto Web 3 without just recreating the existing Web 2 infrastructure that we're trying to replace, and a lot of stuff like that. So it should be pretty interesting.
Very cool.
Yeah.
And another quick note too before we let you go. On the institutional side, it just was released today. Well, the Do Kwon CEO tweeted today that the Q1 Coinbase quarterly report noted that 75% of their volume was institutional and only 25% was retail, which took me by surprise today when I read it.
Wow. Yeah. It's significant.
That's really interesting. And I think that it's also kind of intuitive just on we literally just came out in COVID out of the biggest consumer spending environment probably in history, right? 80% of dollars ever have been printed in the last 2 years. Consumers were getting cash for doing nothing to spend on stuff to use at home. And crypto and stock trading were huge beneficiaries of that. And hopefully, I think part of the idea is, these people are now interested in doing that when they have free capital. And so hopefully next bull market, we see a return of retail. But at the same time, I wouldn't be surprised to see a continued short-term shift of retail out of the trading environment as wallets tighten.
Yeah. So definitely like scary.
And these statistics, of course, were Q1, so before the whole Terra event that we talked about today, which almost certainly, one would expect, decreased retail interest even more. So.
Yeah, I think that's exactly right.
And on that positive note, we'd like to thank Jack for coming on. Great conversation. Thank you very much. And
thanks for having me.
Is there anything you want to say before we sign off?
No, I appreciate everyone listening. If you made it this far, realize I can drone on a little bit. But if you have any questions, feel free to hit me up on Twitter at YoniJMel, YoniJMel. And I do my best to respond to people as they come in. So if you have follow-up questions after this, just hit me up.
Cool. So, thanks again, Jack, for coming on. For those watching on YouTube, you know the drill. Like, subscribe, ring the notification bell, leave comments if there's anything you want us to talk about or any guests you'd like us to have on. You can find us on Twitter. Jack just gave you his. We'll also link it in the description. And same goes with if you're listening on your podcast distribution service of choice, like and share it with your friends and family, all that good stuff.
Tell them about Terra.
Yep. Tell them what you learned today. Internalize it. Take it with you. So thanks, Olivia. Thanks, Jack. And saying goodbye for everyone. Until next time.